Welcome back. You're watching special coverage on Budget 21-22, and I have a very special guest with me now, Mr. Mahendra Jajoo, Chief Investment Officer, Fixed Income at Mirae Asset Investment. Welcome, Mr. Jajoo.
Thank you for inviting me.
How do you see the budget? Your first takeaway.
Well, I think it's a very welcome budget, and the government has hinted in the past also that they will go for a fiscal stimulus once the COVID situation is in control, and they believe that the fiscal stimulus will bear fruit. So I think at this point in time, when the economy has begun to revive, I think this budget, the main theme about the budget is a huge fiscal stimulus through higher fiscal deficit, and that is coming at a time when the economy is accelerating. So in that sense, it is a very good budget. Now, coming back to the fixed income, obviously the higher borrowing program is a little bit negative for the fixed income. We have already seen the bond yields go up in the trading post the budget announcement. Now, the challenge is that the most analysts had anticipated a little bit higher borrowing program. The wider estimates for the fiscal deficit for FY22 were in the band of 5 to 5.5%. Now it turned out to be 6.8%, which is almost 1.5% higher than the consensus estimate. Not only that, even for the previous year, the fiscal deficit, which was widely expected at around 8%, is now projected at 9.5%, which means the revenue collections were slower than what the market was anticipating. Therefore, there is obviously a concern on the higher supplies, and that leads to the concern on the fixed income in terms of the bond yield for the next financial year. Now, it's just not only about the government borrowing alone, because we are now having a very strong tailwind as far as the economic recovery is concerned, and the fiscal stimulus and the other structural reforms in the budget will only help the economy grow even faster. Now, that would obviously mean a higher borrowing or funding requirement even for the corporate sector. Therefore, there is a concern that the higher government borrowing may even crowd out the private sector requirement. And then I think, as Saurav was also saying, that possibly you have a higher inflation given the tailwind of demand, etc. So it looks like a little bit of a difficult environment for the fixed income immediately, but then we know that the Reserve Bank has been extremely supportive. There is by no means a conclusion to be taken that we are out of woods, because the COVID situation outside of India is still very, very alarming. Our economic recovery is at a very nascent stage, and most importantly, we have two very, very favorable factors. One is the global interest rate environment is extremely benign. Most of the major central banks, whether it is Fed or whether it is ECB, are still committed to continued low interest rates, and they are committed to maintaining excess liquidity. Therefore, the Reserve Bank has a strong, support or the tailwind of the benign monetary conditions across the major economy in the globe. And then we have seen today how the equity markets celebrated the expansionary budget, and that also means that we can expect to continue to receive a huge attraction from the FPIs in terms of the portfolio flows. So that will also keep the liquidity high. Therefore, it may be premature to conclude that the bond yields are headed significantly higher. They will possibly they have bottomed out, and there is now clearly room for some spike in the yields. But I think the decisive moment will be when you have the first feel of the monsoon for the next year, because if the monsoon turns out to be normal, then we can breathe a little bit easy. So that's my first impression of the budget and its impact on the fixed income markets.
How do you think the RBI will be you spoke about the rise in the yields and how is it going to impact the RBI is going to play a very critical role in such situations. What is the way out?
So I think for RBI, look, as far as I can see, I think the situation is reasonably straightforward, that the Reserve Bank will want to be extremely supportive, because ultimately the economy has to revive, and for the economy to revive, you don't want to choke the liquidity supply or increase the cost of credit at a very early stage of recovery. Therefore, I think there is a strong logic for the interest rates to remain benign and liquidity to remain supportive. Now, this being the primary objective, the Reserve Bank will possibly still want to look at it in comprehensiveness, which means if you don't have a very strong uprise in the inflation, or if the global interest rate environment remain benign, then I think it gives the Reserve Bank a little bit extra room, because there are two types of challenges that the monetary policy will face. One is the fundamental factors like inflation or the global interest rate environment, which I think at this point look supportive, because we just saw the inflation ease from a very high level to about 4.6 on a headline basis. The core inflation is still a little bit on the higher side, but I think it has remained sticky. So therefore, we cannot expect inflation on a core basis to move very significantly higher. Then the second are the, more contextual factors like the supply management, because at this point the bigger concern of the market is the excess supply. So if the other factors remain supportive, the Reserve Bank can be a little more accommodative by way of the operation twist or the open market operations to, lessen the pain of the excess supply. Therefore, I think at this point the Reserve Bank has ample elbow room to manage interest rates in a way that we don't see a significant jump or a knee-jerk reaction in the market.
Thank you, Mr. Jajoo, for being here.